loud. Whenever you come to the microphone and testify, please speak directly into the mic so that our court reporter can hear you and our community can hear you.
Was directed at me. Yeah. Directed at me.
Good morning. The meeting of the Louisiana Tax Commission is hereby called to order. The meeting is being held at the office of the Louisiana Tax Commission at 1051 North 3rd Street, Suite 225, Baton Rouge, Louisiana. The date is Thursday, October 31st, 2024. The time is 9 a.m. Please call the roll.
Chairman Russell,
Here.
Commissioner Leone.
Here.
Commissioner Romick,
Here.
Commissioner Guidry,
Here.
Commissioner Frazier.
Here.
5 present and a quorum.
Okay. We have no old business, so we're going to move on to the adoption of the tax rolls.
Good morning, Commissioners. Tanisha Malvo on behalf of the Louisiana Tax Commission. Today, we have Jefferson Davis, Lafayette, Point Capiz, St. John, and St. Tammany for approval of their 2024 tax rolls. We have received their quietuses, affidavits, approval letter from the auditors, their electronic rolls validated in our TAM system, the TC-33s, millage reports, and the public service recaps numbers all match and validate with the electronic roll. Therefore, staff requests approval of Jefferson Davis, Lafayette, Point Capiz, St. John, and St. Tammany's 2024 tax roll. And we do have Assessor Lucian Goff here from St. John with us today. I don't know if he wants to speak.
Thank you, Lucian, for coming. Do I hear a motion?
Mr. Chair, I move to approve the 2024 tax rolls as presented by Ms. Malvo.
We have a motion. Any discussion on the motion? Any objection? Hearing none, motion is adopted. Thank you. We'll move on to the appeals. Are there any new witnesses that are going to testify today that need to be sworn in? All right. Go ahead, ma'am.
Thank you. Again, Angela Adolph with Keen Miller on behalf of the taxpayer. And we're going to pick up with Ms. Cartwright where we left off yesterday. Ms. Cartwright, could you look at your appraisal for 2023? And commissioners, in your exhibit book, that's exhibit number 18. It starts at Bates number, page 771.
Okay.
771, the taxpayer number at the bottom.
That 868. Okay.
All right, so what were the, let's go through the same information that we went through for the 2022 appraisal yesterday. So give me just a second. What was the information that you used for the 2023 appraisal?
Okay. Again, I have a foundation at the back of the report. Sorry. I have a foundation at the back of the report that'll list all the information that we relied on. There are also footnotes throughout the report for certain things that are relevant discussions. All of that's the information I relied on. Fundamentally, in the same way as yesterday, I did a financial review of historic performance. Rely on, income statements provided by Financial Reporting Department and in Energy Transfer. I, sorry, I relied on, the Financial Planning Department's budgeted forecasts for what was expected on the date of value, what was the expected performance going forward for next few years. Okay, I did pretty much everything the same way all the way through.
And for 2023, did you calculate value under the cost approach?
No,
What, in your opinion, is the best methodology to value a pipeline system like this?
to value a pipeline system would be the income statement, especially when your past experience with the pipeline, the information that you're getting. You'll look at the financial statements, indicate the possibility of real economic obsolescence. The best approach would be an income approach because expected economic performance is going to be best reflected in a discounted cash flow. Secondarily, though, you want to take a look at the market and how investors are reacting to these types of assets in the market. And that's a good sanity check. It should be considered. And that's exactly what I did again.
Did you hear the testimony from Martin Anthony and Ryan Lee yesterday to the effect that there are no market sales of individual pipeline segments?
Yes,
And does that comport with your experience as well?
yes.
Did you include any utilization information in your report,
No,
and why not?
in a discounted cash flow, it's irrelevant. It's the cash flows that are being generated. You could say that part of the reason those cash flows are down is because it's underutilized. Sorry. But the cash flows that you're looking at that had been, and the reason they're down is because it's an underutilized system for the investment. Okay, going forward, the cash flows that are expected are because it's underutilized, but the cash flows capture that in the most accurate way possible.
All right, let's go through the tables just like we did yesterday. I think we can start with the first table that has the income statement.
Are we going to the income statement? Okay, I think that's like 25. That's the income statement. Table 3 on page 26 of the report.
Can you go through this for us, please?
Okay. All right.
I'm sorry, before you do that, just want to confirm one thing. You said that you received the same information for 2023. Did you conduct the same interviews and get the same, have the same discussions with the folks at ET like you described for 2022?
As in a teleconference this time instead of driving to Dallas, but yes.
Okay, thank you. Back to the income statement.
Okay. They had a better year. Certainly, if you look at the 69.8 million of net income that they had in December 31, 2012, 34.7 million isn't anything to be delighted with it, but it's better than the year before. Again, though, that performance taken into account, you want to have a discussion with financial planning. Is that a better year or is that a trend? Okay, and I had that discussion.
And the next table?
In the common size analysis on the next page, what you see is a slight improvement in the percentage of net income of total revenues, but still the margin's down compared to what it was in 2012. And 2016 and 2019, the margin's still significantly down. Okay, and it's not unusual when a company has been in decline. Generally speaking, and you have to look at the facts and circumstances of each company carefully. Generally speaking, as a company's in decline, they're not going to manage their expenses quite as well as you would think they were. It's not going to stay the same percentages all the time. It's not going to. Decline is a difficult experience for a company, okay? So it improved some. They didn't manage their expenses great, possibly, and more likely because they couldn't. A lot of these expenses may very well be fixed. So we have to take a look at that. We have to discuss it with financial planning. What are they expecting? What do they think is going to happen in the future? And they're going to be asked to do more. If you want to run up, take a look at cost of goods sold. That margin as a percentage of revenue is greatly down, even though revenue's improved. The cost of getting the gas to the pipeline has gone up. That's not something they're in complete control of. Okay? So those are questions you want to ask of financial planning. What are you expecting? They start with gross margin, and they give me what they expect going forward. So there's still some problems there.
So before you go on, let's go backwards just a little bit. I think we skipped the balance sheets and the current asset chart.
Okay, on page 19. Current assets, as you can see, have become a greater portion of total assets. Okay, as I was saying to you yesterday, business enterprise value includes net working capital. It includes easements. So current assets have become a greater portion of it now, as of this date, of these dates. Okay, I think that's the most important thing, but it's still overwhelmingly tangible assets. Next page. Balance sheet. It's very consistent with the year before. There's a slight downtick in overall value. Still pretty consistent with the prior year and the book value of the assets. Now, recall, though, that 2017, they made a fair market value adjustment. So that brought them down there overall. It's required for them to do that study when it appears to the auditors that there's been a change in the circumstances at the company. They're required to bring someone in and do a fair market value adjustment and determine whether or not there's economic obsolescence. So that's not something that happened. That's something that happened over time. And then they adjusted it so that investors would see that. That's the thought behind it. They would be able to see this on the financial statements.
All right, let's move to the next one.
This is common size analysis. This is liabilities and equity. They brought their liabilities down. Remember that Alinda wanted a lot more debt. They wanted to pull some of it out. Energy Transfer, when they're in charge, they end that. Okay? They bring it in, it's a challenged system. You don't want to be encumbered by a bunch of debt while you're trying to deal with market circumstances that aren't particularly favorable for you. So they brought that in line. I'm not surprised. Total liabilities, the uptick to the extent exists is in current assets. So
Okay, let's go to the next one.
just a common size analysis. Property, plant, and equipment as a percentage of total assets on the books at least is pretty close to 80%, just as it was last year. Current assets as a percentage of total assets is pretty consistent with the year before. Okay.
All right, and continuing on to page 21. Sorry. 23.
We're looking at current liabilities, total liabilities, advances from or to affiliates, all relatively modest. They're managing their system as frugally as they can. Not surprising.
Okay, so let's hold off right there for a second. All the information that's set forth in those tables and charts that you went through, again, what is that information based on?
The information comes from the financial statements provided by the financial reporting segment, the department at Energy Transfer.
And does it include forecasts and company planning information?
Not from the financial reporting department. That would be from the financial planning department. Related, but not the same.
All right, what information did you receive from the financial planning department?
Budgets, budgeted performance data.
And is that information reflected in the charts that you just went through?
No,
We haven't gotten to that yet.
no.
So let's keep going.
We're back to revenue. I think we went through that. Okay,
So I think this is figure 23.
yes. They indicated that they had a better year for revenues. They still had pretty high cost of goods sold, so it brought their margin down, but they had a better revenue year in 2022. I think Mr. Ryan described it and the reasons for it in his testimony. Okay, so that's just a chart showing you what happened.
And figure 24.
And that's profitability. Still overall down. Again, though, that big V-shaped dip there. Okay. Let's bear in mind that that's because of an adjustment to fair market value, and the reduction in the fixed assets is reported on the income statements as an expense. So that's not actually after-tax cash flow there. That's not what is the reality of their operations that year. That is the reality of adjusting the fixed assets to fair market value.
Let's move to the next one.
These are ratio analysis. Total liabilities as percentage of owner's capital is up a bit. The quick ratio's down a bit. Their collection period, all the efficiency ratios. You've still got assets to revenue. Their assets are 1.8 on the books, at least, even after the impairment, or 1.8 times what the revenue is. That's not a thrilling position to be in. Okay. Again, though, the percentage net income to revenue, look back historically, it's down. There was a slight improvement, but it's down. Okay.
All right, are you ready to get into the income analysis?
The forecast, in the teleconference, what you want to ask when you look at this is you want to ask, is this just a few good contracts, a good year? Or are you expecting this to be a trend going forward? Did something change? So I got the budgeted performance data, and but let's stop. USPAP requires that I stop here. I've done this. I've laid the foundation for you. You've looked at everything that's been going on. If you read my report, and I wonder sometimes if people do, but if you read my report, you've read the history and the background and everything on the company. Now, before I get into the valuation, I tell you, USPAP compliant, generally accepted appraisal practices. What is it that I'm appraising? And what are the methods to do it? And how do those methods work? Same thing as yesterday, all the way across. I'm appraising, looking at equation 2 on page 32, I'm appraising the business enterprise value. That is my goal. That includes net working capital, tangible assets, and if there is any, and the balance sheet doesn't indicate it, but if there is any, identified intangibles, easements, okay, and unidentified intangibles, going concern value or goodwill, what some people will call blue sky, if that's there. Now that includes all of that. So my goal is to determine the business enterprise value. And a discounted cash flow, I'm using a measure of economic income. Page 33, I point out to you the importance of making sure that your measure of economic income comports well with your discount rate. And almost all the information, the market information for a discount rate comes from after-tax information. So I want to get to after-tax cash flow. If someone uses an after-tax discount rate with net operating income, bingo, you've already screwed it all up. Because that's before tax measure of income, economic income, and an after-tax discount rate. Okay? So that's very important. And as you go through the report, you'll see that I take great pains to point out that my discount rate, the sources, and we take great pains to come to after-tax cash flow. All right, then I go into a market approach, and that's pretty basic. We've already gone over the fact that if you could get a sale with sufficient information to do analysis of highly similar assets, a sale, that would be great. But it's not required for the most part to be publicly available. And I need something publicly available. And I don't think you want to spend 300 million plus, which was the value the year before, on a system without at least looking at what the market information tells you. Okay? So I use the guideline company method. Then there's the cost approach, and I go through that, lay out how it's done. This is lifted virtually straight out of textbooks with the American Society of Appraisers. Okay, so you have replacement cost new, that's physical deterioration or physical depreciation, physical obsolescence, less, if it exists, functional or technological obsolescence, or less external or economic obsolescence, and you arrive at fair market value. Each one of those is if it exists. If we had a brand new system, we might have virtually no physical deterioration. And it's in any given situation when you're looking at just the assets, there could be significant or no functional or technological obsolescence. And the same is true of the economic obsolescence. But in a USPAP compliant report, you have to address each one of them if you use a cost approach. And the best practices way of addressing economic obsolescence, because it's economic again, is with an income approach.
All right, so let's keep going.
Same thing as yesterday. They,
Who is they?
financial planning. All right, can I take a moment and take a drink?
Take a beat. We got all day. Kidding.
Yes, this little Texan is adjusting to the flora and fauna here. That would be appreciated. Thank you. Oh. Okay. Okay, so in 2022, we have $87.7 million of revenue. Not revenue, gross margin. That's where they start internally. They're not expecting at that time, they're going to have to report up the chain to executive management. That's not what they expect going forward. It's not going to be delightful news for executive management, but they're sure not going to tell them anything that is rosier than they really believe, because they have to live up to those rosy expectations, right? So they're expecting a relatively modest decline in 2023 to 76.5 million. And then another decline in 2024, and then moving right down the line. Okay, a decline. Now, I stabilize it then. I just keep it stable in 2026. And I just bring it up to the long-term rate of inflation after that. I don't keep guessing at what kind of declines they're going to have, if any. Okay? I just stabilize it and bring it up to, for a long-term growth rate in the terminal value, the long-term rate of inflation. That may be rosier than each coming year, the financial planner is going to tell me, but I'm trying to develop a fair discounted cash flow where I'm not projecting ongoing declines. And certainly, as someone pointed out to me once, even if they're expected to decline, you can't decline in a terminal value in perpetuity. You'll close. Okay? And I'm not here to project when they will. So benefit of the doubt, long-term rate of inflation. Okay? Again, they're forecasting adjusted operating and maintenance expense in 2023, it was 22.2%. They expect it to be 27. Now, bear in mind, as revenues decline, the percent, even if the expenses are declining a little bit in real dollars, as a percentage of those revenues, it's going to tick up a little bit. Okay, so In 2024, they're expecting it to be 27.1%, and 2025, 33.2%. And again, given the benefit of the doubt, I just say 33.2% going forward. Same thing for general and administrative expense assumptions. In 2023, it's 3.3%. 2024, they expected it at 4.5%. Now they're expecting declines again, percentage, even in real dollars. If it has gone down a little bit, it can still go up. 5.8%. Okay, but I talked to them and they don't think it's going to stay there. They think they'll bring those down a little bit. They'll bring it into line. So I forecast a kind of gradual decline to about 5.4%. Okay, capital expenditures, they tell me they expect to, this is maintenance, spend about 2.4% of gross margin every year. That's where I'm at. Now, after that, I'm looking at industry typical net working capital. Again, if I remember correctly, they have excess working capital. All right. So that's dealt with at the end by adding it back before I arrive at business enterprise value, because it is working capital that they do have. Okay. I developed my WACC in the same way I did yesterday, weighted average cost of capital, because I'm valuing total invested capital, which is the same thing as business enterprise value in terms of its value, right? So if you value that, you have to value it in a weighted fashion, debt and equity. But remember, you have to do it in ratios that are typical of the buyers in the market, because that's what they'll be looking at when they go to consider buying this. How would they finance this? How would they operate it? Okay, so I go through the WACC. I tell you about the capital asset pricing model. Okay, a company in decline, I assign the same company-specific risk premium as before. I pull the beta from the market comparatives. It's a levered beta because I'm using typical industry debt to equity ratios, because that's the market for these assets among those buyers, those potential buyers. And I apply size premium in the 9th, 10th decile. There's significant, virtually overwhelming evidence that the smaller the company, the greater the required rate of return overall for investors, for the willing buyer. So if you have a higher required rate of return, you have a higher discount rate. We have research. It's available through, at this point in time, Duff & Phelps 2023 Cost of Capital Navigator, where I can get what the average premium is for the size premium. Okay, I can get it, and I can add it in here. Table 10 on page 43, just like yesterday, goes through and lays that all out. It's not much different, but what we find is the beta's a little lower. Investors are perceiving it as slightly less risky compared to the market as a whole. Slightly, but it does have an impact on the discount rate. Okay, and that's the cost of equity. Then again, these are the same. It's the same thing again. I have both equity and debt investors, just like yesterday, typical to the market, typical of the buyers. Okay. And I have to look at what is debt common for them. I go through and do the research for it and show it to you. And cost of debt is up some this year in 2023. You recall what was going on in the economy in 2023. Interest rates are up. They're trying to slow us down. Don't you just love that? Okay. And that means that debt overall is more expensive. You see it here. So weighting debt and equity and doing that where instead of having ad valorem taxes deducted and the discounted cash flow, I don't deduct them, but I add the tax effective property tax rate in what I have. And to the weighted average cost of capital. Okay. And then we go and we have now a 14% discount rate. Again, slightly up, I think, compared to last year. I think it was 13 point, but not by a whole bunch. And that's primarily because the cost of debt is up. All right. Then you can see my discounted cash flow.
And what table and page number is that?
It's page 46, table 13. Okay. And that's, I'm coming up with a value with the discounted cash flow for operating before I add back working capital, excess working capital, which I have to do. My operating business enterprise value is down somewhat. And that's primarily because the cost of debt is down. And if you were one of those willing buyers out there, your capital and your capital, your equity is up a little, but your debt's up a lot. Okay. So to finance this acquisition, you'd have greater costs, and that's reflected in where they put the value. Now, this all seems like a lot of detailed work. For $300 million, investors have someone do this kind of work. The sellers do it, the buyers do it, and they both come to the table with this kind of work behind them. They're buying cash flows. That's why we have a financial planning department. That's why we have consultants. This is what they're doing for this. This is how they're determining ultimately where they strike. Ask, bid, strike. Okay. Now, my experience too, which I'm sad to say is over 30 years, they always take a look at market conditions. They look at the market out there. What's going on with the market? If they can find a sale, they look at that. If they find even one sale, they practically dance over to your office and tell you they found it. Okay. But if they can't, and they usually can't, we use the guideline company analysis. Same exact method as yesterday. I'm buying a whole system. So the value is going to be higher because I'm buying control. I'm buying a much smaller system. So the discount rate is going to be higher because they just require a greater rate of return on smaller companies. Investors do. Okay. I develop multiples. I go through for total invested capital, the market value of invested capital. And then I use those to develop an indication of the market value of business enterprise or total invested capital on a controlling basis, using my language. Okay. And then I laid the value indications with those multiples out against my DCF. And I ask myself, do I make sense? You can look at figure 25. I do. You can look at the comparative values. I do. Using those multiples. This is how the market's looking at it too. But then when I reach a decision, I have to add back excess working capital. And they have, remember that current assets were up. They have excess working capital of only over $25.7 million. I have to add that back. So I'm back to about $306.7 million in concluded business enterprise value on a fair market value basis. Now, you say, this assumes that the buyer is stepping into the shoes of the former owner, that they acquire all the assets that are there. Okay? That's what's there. Net working capital, tangible assets, any identified intangibles, such as easements, and any goodwill, all of it.
I think you said this along the way, but was there very much of a difference between 2022 and 2023 conclusions of value?
Primarily because the cost of debt is up significantly. Okay. The operating business enterprise value is down. Not dramatically, but it is down. Because any willing buyer would have to finance. And with typical debt to equity ratios among those buyers, they would have to finance it in part with debt, and debt's much more expensive on the second date of value. And that makes the price that they're willing to pay a little lower because their financing sources are a little more expensive. Okay? But this year, they have significantly more net excess working capital. Current assets were up notably. Okay? Given that, the value stayed pretty consistent.
All right, so did you calculate obsolescence in your analysis?
No,
So your business value enterprise does not reflect obsolescence in this pipeline system?
it does.
Okay, sorry, then, okay, can you explain how it does?
Okay, if let's say that the group in an acquisition that is looking at the assets comes to me and says, you know, that the assets, they have assets all over the system and the assets are coming in at replacement cost new, less physical depreciation, significantly higher than my business enterprise value. Then they're not going to pay more than my business enterprise value by much. Okay. So what that says to me is there's significant economic obsolescence along the system, that it isn't able to generate a return sufficient to support the value of those tangible assets at replacement cost new, less physical depreciation. So a willing buyer won't pay that much for it. It's easy to understand if you think about it in smaller numbers. If you had a store with a whole bunch of assets in it that generated $1,000 a day, okay, selling widgets, and over time, those widgets didn't have as much of a market as it had before, and it was generating only $500 a day. And I'm not implying this has anything to do with these numbers, just using it as an example. A buyer coming in would not pay the same thing for the assets there to generate that income that they paid when it was generating $1,000 a day. They want to get a return on what they invest that is reasonable. It isn't generating what it did before. It's worth less. Ultimately, when you're buying business assets, you're buying cash flow. You're buying what you can get out of it, what money will be put in your pocket. And again, I caution you that the investor is looking forward. What has been earned has already gone in someone else's pocket. You want to look at it, you want to understand what's been going on, you want to know the story, but your focus is on the future. What can I get out of it? That's why they hire people like us.
So how would you calculate the percentage of obsolescence in this instance?
Okay. If I were allocating the assets in a purchase price allocation, and sometimes after the acquisition, we are called upon to do it. Okay, we would take the assets at their replacement cost new, less physical depreciation, and we would pro rata cut them down for economic obsolescence. And that would pass audit without a murmur. That's what we do. Because we're valuing the system and they want to put the assets on the book at a reasonable approximation of fair market value.
So that sounds rather straightforward, but I think yesterday you said it was very complicated.
It's complicated because you have to arrive at the replacement cost new as physical depreciation for each one of those assets. You have to collect all that data on all the individual assets for the depreciation. It takes time to do all of that. Fortunately, I don't have to do it. I usually have a fixed asset appraiser who is putting all that together. And then I arrive at the end to tell him, and he says, well, these assets are worth 600 million. And I go, no, they're not. So we take out the easements that someone else has valued. We take out any other identified intangibles. We take out the working capital and we say, this is what they're worth. And they have to be cut down because that's the kind of return they can generate. That's their justification for existence. Okay? So it is complicated. It is time consuming. In concept, it's not that complicated, but it's complicated.
So if you had the replacement cost new, less depreciation,
Physical.
for physical depreciation, thank you, for these pipelines, and you had your business enterprise value, how would you allocate the obsolescence down to the parish level? Not to the asset level, just to the parish level.
I don't think I ever have been asked to, but let's say it's a reporting unit. Okay, I guess that's roughly comparable. We could allocate them down based on the assets that are there. But basically, in our parlance, all the assets take a haircut. They're not generating sufficient return to justify the value there. So the buyer, who I'm more often working for, okay, is going to come in and they're going to cut those assets down. But recall, they are going to do this. They're going to do it across all the assets. Now, those assets get to be depreciated when this moves over on the tax books. So they're not cutting them down because they're just delighted with it. They're cutting them down because it isn't going to pass an audit if you don't. Okay. Those assets are worth less. Depreciation, when you do your tax returns, shields income. Okay. So they're not just doing this cavalierly. They're cutting them all down. And usually the auditor will expect us usually to do it just to pro rata across the board. Okay.
So, again, last year, I think you just divided one number by another number to get a percentage. Is that what you would do again this year?
I didn't do it in this year. I haven't done that. I'm saying,
Sorry, I'm saying, could you do that? Divide one by the other to get the percentage?
yes, I could. The most appropriate way would be to have the easements valued, take out the working capital, and take a look at the land, take that out. But you can take, they're not doing a purchase allocation when they're trying to talk to these people. So you can say the value of the total assets is this, and the value of the business enterprise value is significantly below. Prorated that it indicates this kind of obsolescence, and then allocate across the system. You can do that. That's not inconsistent with what you would typically see in a purchase allocation. But it is ignoring the fact that the business enterprise value includes easements and net working capital. Okay, but if you take those out, you've come to a little better approximation of what the value attributable to tangible assets are, because at this point, you're not going to have goodwill. There's not any blue sky here. They invested a significant amount of money in a system moving east, and the market's not in the east now. The market's in the south.
So is that part of what you were doing yesterday when you were, you and Mr. Eddington were looking at the pipeline system that he has on the board over here to the left?
No, I was responding to Mr. Romick. He asked a reasonable question. Was it possible that there's more obsolescence in some areas? I would have to have more information, but based on what I remembered of what Mr. Lee was saying earlier in the day, and I told you to have to go back, talk to them, okay? I thought, well, it's possible, remotely possible, that maybe the further east you go. But the reality is, I found out later when I looked into it, looked at their testimony and looked into it, that there's no route south for the western assets either. Not on these dates of value. It's remotely possible that in the future that there may be, which would change the whole dynamic of where you allocate obsolescence. But at this point in time, this is a system that was built to move east. There's some off ramps, okay, for the natural gas along the way, but it's designed to move west to east. So unfortunately, in that kind of situation, while it's remotely possible in the future, they could get some access going there, maybe, but not with the assets configured as they are. I think you'd fall back to the purchase price allocation way that we would do it, and just allocate the obsolescence across the assets. Because you're kind of stuck with that when that's all that is. It's moving west to east. There's no route south really. So they're all part of a system.
And based on the projections that you got from the financial planning group, they didn't seem to have anything like that teed up in the next year or so.
No, but they have
Okay.
nothing like that teed up for the foreseeable future. He asked, is it possible? To respond with
Anything
complete
is
candor and
possible.
honesty to Mr. Romick, it's remotely possible in the future. It just isn't the situation for these dates of value, and it's not on the table in the foreseeable future. It wouldn't be the system that we're addressing here.
On page, just to kind of wrap up here, on page 35 of your report, you have a replacement cost new, less physical depreciation, less functional and technological obsolescence, less external or economic obsolescence equals fair market value. Do you understand that this is the type of replacement cost new methodology that is in the Louisiana Tax Commission guidelines?
I have no reason to doubt that their replacement cost new is a reasonable approximation of what replacement cost new is. I have no reason to doubt that their physical deterioration is a reasonable approximation of it.
And if obsolescence is not accounted for, then it doesn't reach fair market value.
If they do not address external or economic obsolescence or functional or technological obsolescence, then no. Now, this is the methodology that any ASA, MTS appraiser would undertake. He would do it if he did a good job, okay? But if you don't address it, then it's not compliant. If you don't talk about it, if you don't, but you may, given the facts and circumstances of any individual company you may be dealing with, you may find that there is no functional or technological obsolescence. I don't think you'd find any material of either one of those along this system. It's well maintained, they're good assets. But the economic obsolescence is definitely here and in a sizable amount.
Thank you. That's all the questions I have right now.
Brian?
I think I have just a few. Just quite right, looking at your appraisal, it looks like you once again prepared a fair market valuation of the business enterprise of Regency Haynesville Intrastate Gas LLC. And this one is for as of January 1, 2023, correct?
Correct.
And just as in your 2022 report, you did not value the tangible assets, did you?
No,
And a few moments ago, you were talking about, in response to some question from Sadoff, about allocation of the operating business enterprise down to the parish level. That's not addressed anywhere in this report, is it?
no,
Okay. And we'll look at your report, specifically page 18. I see that you were provided an additional year's worth of financials. And I gather that would have been for the financial reporting department.
it would be.
And looking at page 37, I see you were provided an additional year's worth of business forecast through 2029. And I gather that would have been from the financial planning and analysis division, correct?
Correct.
So, and because I didn't realize this until today, those are two different groups, two different divisions within
They
Energy
are
Transfer?
two different groups,
Okay.
but they do work with each other. If you're thinking about them as two really discrete people that there's no, they're talking to each other.
No, again, look, I was simply asking because I didn't realize there were two different groups
They are.
providing this information. Okay, were you provided any information that was materially different than in 2022? Again, excluding the updates. We provided the same type of information.
Oh,
for
yes,
23
yes.
as in 22. I know they were updated, but
They were
you
updated,
didn't
but it's,
receive anything new, any new documents, again, other than updates that
No.
were different from what you received. Okay, and I assume as in 2022, these, financials and business forecasts through 2029 were the foundation of your appraisal.
the historic financial statements were provided for history and for their USPAP required financial review. The financial planning was provided for the discounted cash flow.
Hey, no, look, it's not a trick question. Yesterday, you testified on your 22 appraisal that information was the foundation of your appraisal. I'm just asking, is it also the foundation?
Yep,
of
the
your
entire, yeah, the appraisal.
2023 appraisal?
Mhm.
Couple, actually just two quick follow-ups. So I'm gonna kind of ask them randomly. Yesterday, you talked about the intended user
Of the report.
of the report. Who was the intended user of both the 22 and 23 reports?
Energy Transfer, Property Tax Partners, any of the assessors that they provided to. And ultimately, if it does go before the Louisiana Tax Commission, these people, these commissioners, that's the intended user.
Okay, now, Energy Transfer obviously would have had all of the financial reports and business forecast,
They did.
correct? And you testified yesterday that when you received the financial data and business forecast, Property Tax Partners also received them.
I assume so. They're
Okay.
on the email chain.
Okay, do you know if the assessors received any of that information?
In my report,
No, no, no. I'm talking about the actual data underlying your report.
my report includes the actual data.
No, no. You said that you relied on financial statements and business forecasts. Was the documentation you utilized to prepare your report provided to the assessors?
They were not on the email chain.
Okay, simple question. What about the tax commission?
They receive it embedded in my report, faithfully reproduced.
Ma'am, I'm going to ask you one more time. The actual data that you received, that you utilized to prepare your report.
This is the actual data I utilized to prepare my report, faithfully reproduced and reported in my report. It's unchanged.
And
Ask Jerry what Jerry's, I can't pronounce his last name.
Ma'am, what he's asking, I'm gonna, so we
It-
quit
it's
going
just-
around. What he's asking is, is the information, the actual document you received for the planning and the budget and the thing included in your report? It's a yes or no question.
What I got on the email chain?
yes,
It's misleading, but yes, no, it isn't.
thank you. That's the only question. And one last question. I want to follow, because I'll be honest, I started asking, I think we got off on a segue yesterday. I'd ask you about the difference between operating business value and going concern value. As I understand it, you believe there's a difference in those two terms?
there
Perhaps
is.
I missed- Okay, what is the difference between operating business value and going concern value?
An operating business value is a value of all the necessary assets, hence it excludes excess working capital, the necessary assets to operate the business. Going concern value is an intangible asset that is part of the unidentified intangible assets. Going concern value may or may not be present in a business enterprise value. You use the term differently than an ASA appraiser does.
Okay, well, I'm not an ASA appraiser, and in common usage, a going concern value is the value that a business enterprise would be sold for. Is that
if-
definition fundamentally different than your operating business
I
enterprise
can't
value?
speak to what your common usage is as an attorney. My common usage is, it's a subset of goodwill, may or may not be present. Business enterprise value is the business enterprise value.
Okay, it's the price that somebody would pay if they were to purchase a business enterprise.
Correct.
Thank you. No further questions.
Right, I just have just a few questions. With regard to the information that was provided to the assessors, I think you were about to say something about Mr. Jerry Swatek's review.
When I get the information, I'm required to reflect it wholly and accurately in my report. Okay? So I do, because I'm required to, because it's supposed to be a meaningful representation of the historical performance of the company for the financial statements. And it's supposed to be used in forecast, it's financial planning. So when I reproduce it, my report goes back to Energy Transfer. Jerry reviews it, ticks and ties, and makes sure that my financial statements, the information that I am using is the same as what is in the documents. okay? That I haven't changed anything either on purpose or accidentally. And the report cannot be used until after he does that.
All right, and finally, I think last year you were asked a question about whether you were trying to have your valuation sort of back into either the Grant Thornton valuation or the PwC valuation. Is there, did you try to back your reports, either 2022 or 2023, into something else to sync the numbers up?
I never even read the Price Waterhouse valuation. Never saw it. Didn't want to see it. Because whether you intend to or not, if you look at someone else's opinion of value, it'll start coloring the way that you do your analysis. So generally speaking, if someone asks me, do you want to see what other people have done? I'll say no, because I'm being paid for my opinion, not theirs. Okay? But I'm not aware that Grant Thornton did a valuation. Did they?
There was a question that you were asked previously, and I just wanted to clarify that you didn't try to back into any of the
No,
other
I
numbers.
didn't.
Thank you. That's all the questions I have for Ms. Cartwright.
No further questions.
Okey-doke.
Mr. Chair, may I ask a couple of questions first?
Yes, Commissioner.
Edrington, I'm confused by a couple of things that you said that I'm going to ask for clarification. You said a common knowledge of going concern. Again, I'd like to know your definition of that.
Going concern value is a value that a going concern business enterprise would be sold for. Which.
How is that calculated?
How is that
Is that
calculated?
defined in accounting terminology, appraisal terminology?
No, it's just again, common usage. It is a value that a business is calculated. However, you would calculate it, it would differ from business to business, I would assume. But again, in common usage, that a going concern valuation, again, reflects whatever the sales price of a going concern business enterprise might be.
So have you seen the 2017 audit of Grant Thornton?
The 2017 audited financials?
Yes, sir.
Yes, I have.
And a going concern opinion there was an issue with going concern.
There was.
So when they impaired those assets in that year, do you think that the ending equity is what that business was worth, given your theory?
No, that was actually what they pitched, and, we brought that all the way to the Louisiana Supreme Court, and they said that, no, it was not.
Okay, so that's my confusion.
Okay, no, again,
Ms. Cartwright,
I'm just trying to nail down on terms.
Thank
Again,
you.
that was not a leading question.
I'm also confused by the question, Mr. Chair, that you tried to clarify relative to the information that Ms. Cartwright used in her report. If that was the same information that she received, was that the actual question? To perform the report?
No, actually, I was asking about the documentation.
That's what I'm saying,
Yeah.
clarifying.
Again, they called 3 witnesses yesterday that each said that they reviewed and were able to verify the numbers, the values in Ms. Cartwright's appraisal. And I asked them, how were they able to do it? They said, based upon information we received from the financial planning and analysis division and also the financial reporting division. My information was that information that Ms. Cartwright received, and that the 3 persons that testified that they were able to verify her number was that the raw data, the data underlying the appraisal was that provided to the assessors and by extension to the tax commission.
So the question was more so, did Ms. Cartwright provide that information directly to the assessors?
Oh, yes. Yeah, no, right. Because she would only have knowledge of what she provided. I want to be clear.
So Ms. Cartwright, a couple of questions for you. Given your report, do you have restrictive language on the distribution of this report and its intended use?
I have intended users. I don't.
So if you would read
specifically
the
say-
second to last paragraph of your report. First
Of the
sentence
report, not the,
of
cover letter.
page where your signature is.
oh, my signature, so
Yes,
that's the
ma'am.
cover.
Your
letter.
letter to Ms. McCavanagh. First sentence, second to last paragraph.
Yes,
So I read it, this letter and the accompanying report are intended solely for your benefit and use for the specific purposes or purposes noted herein.
yes.
That's going back to page 1. Second paragraph, does your report read, our evaluation is a limited scope appraisal which will be used to provide a fair market value indication of Riggs business enterprise for Louisiana property tax purpose as of January 1, 2023.
That's correct.
So it's specifically to Miss Megan McCavanagh and would never, the intended use was never for the assessors themselves. So you would never be authorized to distribute that to the assessor.
Asked
Correct.
for the
That was the
authorization.
intended
I
use.
have to. I have to because she's my client. My code of ethics requires, because she's my client, that if it's distributed to others, that I ask her permission. So she informed me that it was going to be distributed to the assessors and that it would possibly be used by the LTC. And of course, that's fine. You aren't, once she gives us permission for that, you now are part of the intended users.
Thank
That's
you.
according to my code of ethics.
Thank you. One last question. I know you didn't, you testified that you didn't look at, and I'm assuming PwC did the impairment testing. Grant Thornton utilized that for validation of the measurement of those impairment of the assets in 2017. My question is, the fact that there was an impairment in 2017, does that alone, I know it doesn't project into the years that you have, but some credence when you think of the economy and what's happening in this market, that there were issues that would at least give you, when you look at the economy and what's happening in the market, that, hey, there was a lot of noise, there was a lot of trouble that actually got reflected on their financial statements in 2017.
That's true. I can see that it was impaired. I was not given the PwC impairment. And if it was for anybody else, just so you'll know, I would not have been willing to see it.
No, my question is
But-
just simply, does that speak to the economic distress of this industry?
Oh, absolutely. As an appraiser, absolutely.
Thank you.
It does speak to the economic distress.
Thank you.
Any other questions from the commission?
I have one. Just, so now we're talking about the future income. Was there something in the, you see how much it falls going forward? Was there something specific in the data that said that's why it's gonna fall so much, or was it just that's
Ma-
what they thought?
It's not
But-
just what they thought. When I asked them, it's because they're not able to negotiate contracts in as favorable terms as they have been historically, and they expect it to become even more difficult as they go along. These producers just aren't willing to pay those prices anymore.
Thank you.
Any other questions for this witness? Hearing none, thank you, ma'am.
The taxpayers would call Steve Grace. Mr. Grace, could you state your full name and business address for the record?
Stephen Grace with Property Tax Partners located at 5700 West Plano Parkway, Suite 2250, Plano, Texas, 75093.
Can you describe your educational background?
I have a BBA in Finance and Economics from Texas Tech.
And what is BBA?
Bachelor's of Business Administration.
And what is your position with Property Tax Partners?
Managing Director of Property Tax,
How long have you been employed in that capacity?
12 years.
And prior to coming to Property Tax Partners, could you describe your work history?
My work history, I started with the Dallas Appraisal District as an assessing officer at a personal property division. I moved from there to Arthur Anderson. At that point was a good decision, and then ended up for Sarbanes-Oxley. It demised our practice at KPMG. I'm sorry, I went from Anderson to KPMG to another group called Paradigm Tax Group, then Duff and Phelps, and then Property Tax Partners.
So what is Property Tax Partners?
We are a full outsourcing property tax group that handles everything from value negotiations to filing returns to helping with processing tax bills.
And what states do you work in?
Primarily all the states that touch Texas, so Texas, Louisiana, Oklahoma, a little bit in Arkansas, Kansas, Colorado, and New Mexico.
Right, is Riggs one of your clients in Louisiana?
Yes, ma'am.
And did you file 2022 tax forms for Riggs in Louisiana?
Yes, ma'am.
All right, let's look at Exhibit 1.
Yes.
All right, can you walk us through this exhibit, please?
This is, all these are kind of going to be boilerplate by assessor. We kind of put it all together. It's all kind of one system. What this is the personal property return for 2022 that we filed to the local assessors. Included in that is the Sonras data, that it's public information. It basically shows the volumes that are being transported in the system. We basically did the average 675. That's what they were pushing through that system during calendar year 2021. The next page basically walks you through the revenue, the income statement for Riggs, kind of shows you what the net operating income. As you can see, there's a sharp decline from 87 million in 2016 down to 11.6. We also have an indication of value of the enterprise value of 295 million. That was done by Patricia Cartwright, and she testified just a second ago. The next section just kind of gives you a little bit more of a history of Riggs, of how it was developed. I know that we've kind of gone through that. The next is your EBITDA outlook. You can see on taxpayer statement number 3. You can see the EBITDA outlook. You can see that shelf, basically what Martin and Ryan had stated. They had firm contracts for 10 years when they originally built the system, and then you see that dropped off significantly because those contracts have rolled off. Then we kind of go into how we develop and how we basically push this value through the system. So when Patricia does her business enterprise value, it calculates for the entire system from the far west to the far east. So what we're looking at is we do the LTC schedule. We develop it just like you normally would, using your schedule values by diameter, compressors, or meter, whatever else we have. And basically, in this case, we totaled to $995 million using the RCN. We depreciated those assets using the LTC schedule to derive a value of $580 million. And then what we do there is we take the business enterprise value less working capital to come up with a fair market value. Working capital is not exempt. We're not getting in the details of land and easements. We are trying to find and develop. We know this thing is not doing well. We want to try to find the best value that we could. This is full freight. There's no arguments on this is the value that was in the statements from Arthur Financial at 295 million. We take that divided by your LTC schedule, it comes up with basically an obsolescence factor of 49%. We basically spread that through the entire system. The value of the property was valued as an entire system. And we're trying to be fair and equitable across all parishes, no matter what it is. So that way it's consistent all the way through. And basically it's just a summary of just reconciliation, just showing how much we did obsolescence for 2022.
So let's talk about the forms that you filed. What are the forms, the tax commission forms that you submit for the parish?
There varies by parish. Some of them are lat 5, some are lat 12, some are lat 14s. It's real exciting stuff when we get down into it. But most of these forms were filed. What we do is we take the form from the state. If we're supplied it from the parish, we'll use that. But the back pages of that is our detail showing the math and the calculation of how we developed it for your specific parish by account number.
Right, so although the forms themselves look blank, you didn't submit blank forms. You had this additional information attached to the rendition.
Yes, ma'am.
And did any of the assessors ever object to submitting the lat forms in that format?
No, ma'am.
Right, and just to be clear, the system that you were submitting these renditions on, the pipeline system, that's the same pipeline system that Martin, Anthony, and Ryan Lee were describing yesterday.
Correct.
All right, and so for exhibits 2 and 3, those are the two other parishes that issue in this appeal. Are the cover letters essentially the same?
Yes, ma'am. They're basically boilerplate. Every one of them's gonna be the same.
And was there any meaningful distinction in the parishes, between the parishes and in terms of what information was rendered?
No, it's the same process, LTC schedule times the LTC depreciation, and then adding in our obsolescence.
All right, and at the time that you submitted the renditions, did you get any feedback or questions from any of the 3 assessors here?
We did not.
Do you include utilization information in that cover letter? I think you mentioned Sonris.
Yes, ma'am, we do. It's on page 1 or page, in this case, it's page 15. It's the Saunders data right in the center.
Did the assessors ask to see any backup information for the utilization information?
They did not.
Did you calculate what the system utilization was based on the Sonris information?
I'm sorry, can you repeat that, please?
Did you calculate obsolescence based on, or I'm sorry, did you calculate utilization based on the Sonris shipping volumes information?
Yes, the utilization is calculated in the body of the email. At the very bottom, it's basically calculated at 32%. If you take the 675 divided by 2.1.
And what is, again, what does the 2.1 BCF represent?
That is the design capacity for the rig system.
And that reflects the segment by segment composition of the system. So you've got a 42-inch pipeline here, you've got a 36-inch pipeline there.
Correct.
Did the assessors understand that you were seeking obsolescence when you submitted this information to them?
They understand that, yes, that we are requesting obsolescence. When we first started working with the assessors, we date back to quite a few years with the assessors. We knew this cliff was coming. Everybody knew it was. All these contracts were going to start running out. As you know, from the history of this, when we started, we had the impairment study that was done in 2017, 2018. We had the sale with Olinda. All these indicators are pushing this value at that point in time around the 400 to 440 range. Obviously, it was a significant decrease from what the LTC schedule has, because this is primarily the economic obsolescence isn't calculated in y'all's schedule. And we get that because this is a company specific issue. I mean, for the commission to be impossible for you to go through each company and do that individually. So that's why we went out. That's why Megan went out and hired Arthur Financial Services to do a study on an independent study on herself. And then that's how we calculate that obsolescence.
When was that Arthur Financial Services appraisal provided?
For 2022. It would have, the actual appraisal,
So before we do that, just I think I asked this already. Did you submit the same information or similar information for the other two parishes that's reflected in Exhibits 2 and 3?
Yes, ma'am.
I'm sorry, back to where you were?
So the appraisal, usually we would submit that with our open book letter. And we can get to that on
So what is an open book letter?
open book letters, that timeframe of in August that we have the ability to go talk to the assessor, go through the issues, go through what are we seeing, what are we projecting, what values we're looking at, and basically give this company specific information of why there's obsolescence and why it should be granted.
All right, let's go through Exhibit 4. I think the information is roughly grouped by parish. The correspondence communications with each assessor are grouped together.
The open book is going to be basically the same for each parish. We kind of boilerplate it the same way because we treat this as a system. So everything will be done as that indicated as a system. So if we go through the open book letter again, it kind of gives you the history of where it came from, why we're here, and where we're going forward. Let's see. It gives a map of the system, kind of details out where this is pushing the gas. You know, as they stated before from Martin and Ryan and everybody, basically when we develop this system, we want west to east. When we're pushing that gas west to east, it hits up with the big interstates that are on the far eastern side of Louisiana. And then that gas, when it was done in 2010, it was to push that gas up north to the northeast. So when we look at where gas flow should go at that point in time in 2008, 9, and 10, we wanted that gas to go up north. That's where all the load centers were. That's where the power was needed. All that gas was going up there to the big manufacturers up there on the East Coast in New York and that area. So when Energy Transfer developed the system, all that takeaway capacity was supposed to move from west to the east and then up to the northeast.
And then what happened? Is it still going to the northeast?
It is not. That gas is turned around, as stated before from everybody else. Everything's going to the LNGs. I mean, everything that they're pushing is coming down. They're hitting that far eastern side of the state and pushing down to the LNG facilities. Now what we're seeing, we're starting to see the reversal, and this has happened a few years ago, where they're reversing those pipes. Now we're getting gas because of the Marcellus Shale that was up in the Pennsylvania area, New York, New Jersey, and all that area, West Virginia. They're pushing that gas down to us or down to Louisiana. It's great for Louisiana, but at the end of the day, it's not great for how the system was built, how it was pushing everything from this side to that side and not straight up and down. Going through the analysis, going through the open book, we also provided the impairment study. We showed the income statement, basically, and the balance sheet based on the financials from the company, showing the demise and.
I notice here in this first letter, you mentioned the removal of compressor units. Can you explain what happened with those?
Yes, we removed basically 30% of our horsepower, which is significant. Anytime you move stuff from one system, it's not going to be able to push as much gas. Therefore, we're just not moving the volumes that we were intended to design to do. So we took one unit off of Cane Hill, a few other ones off as well, but at the end of the day, we reduced our horsepower by 30%.
Just real quick, when was that done?
That would have been done in 2021 because we're looking at the 2022 year, sir.
And so at that point, that's when your utilization rate, as far as what the system can do, that was testified yesterday. It was testified that it's only 1.2 million now,
Yeah.
not to 2.1. So that would be the point that
Yes, to get us
happened.
back to the 2.1, we would have to add those compressors back. Yes, sir.
Wanted to clarify what the pipeline can do as of those dates. And it's 1.2.
Yes.
So can you go over the pipeline design and that the the pipeline capacity versus the compressor capacity? Because I think there might have been a little confusion yesterday when Mr. Lee was talking about this.
Well, when you add compression, obviously we can get to the 2.1, but right now we're running 1.2. But if we were to specifically look at one compressor station in general, and specific is Cane Hill. Cane Hill was a compressor station. We started with 5, we're down to 4. And these, I've been out there multiple times. It's rather large compressors, very loud, etc. But they have removed one of those compressors. Now what we're running is basically one a month just to keep them active, but they're running about 25% of what they could run.
So the Louisiana Tax Commission guidelines and the way that the assessors value the system, though, it's based on how it's built out, right?
Way we're calculating is based off of design capacity.
And so compression doesn't factor into that part of the analysis.
It does the total capacity, the total design capacity when we originally set this up was 2.1.
All right, so I think the next thing listed in your letter is a compression, I'm sorry, compression study.
Yeah, this basically goes over what we were talking about before. It shows the calendar hours, the operating hours, and the total number of units. I mean, we're operating, I said it's getting worse, I think. We're operating about 43%, and that's on total on an annual basis, so your total run times.
All right, and continuing through the letter.
The next is going through the valuation, going through, basically, this is the income approach, income statement, or and some of the balance sheet down here with the property, plant, and equipment. Then what we do is we basically take the Arthur Financial, the USPAP appraisal done by Patricia. We back out working capital, and we divide that by the full LTC, RC, and LD. So the Louisiana Tax Commission's guidelines, the RCN minus your depreciation, come up with the fair market value. We divide the Arthur Financials divided by that, and that basically calculates an obsolescence throughout the entire system.
And so that first number, the RCNL, that number is based on the 2.1 build-out design capacity, right?
Well, the RCNLD is based off the Louisiana Tax Commission guidelines. So as you
Which
can,
is pipeline mileage and diameter.
correct. And as you can see in the graph, it says the rigs valuations, it's on page 70. We kind of inserted in the LTC guideline values and going back to 2018 to kind of show you how this is progressing. If we look at the end of year 2021, which would be tax year 2022, the guidelines value is 579 million. Our net PP&E was 359. And the USPAP appraisal came in at 295. So then what we do is we basically take the USPAP appraisal divided by the LTC value. That calculates how much obsolescence we're requesting for the entire system from west to east. And then we basically go into our summary. This basically shows on page 70 at the bottom, we're looking for a 49% reduction for economic obsolescence.
And what did you have submitted along with that letter? What attachments?
The attachments, we have the compressor run times, then or run times. We do have an analysis by an engineer basically showing the 42 and the 30 of how much pressure we could put onto that system between those two legs of the 36 and the 30 and the 42.
And what are the conclusions of that report?
In general, what they're saying that it could be replaced with the 36 and run at their current volumes. They could run it down that leg. if need be. But remember, this is a total system is what we're looking at and what we're concentrating on.
So if I understand the report correctly, the engineer said that if they were going to rebuild that 42-inch pipeline, they would not rebuild it at 42, they would rebuild it at 36 to accommodate current shipping volumes.
That'd be correct. If they were to rebuild it, of course, well, anyways, the next document that you see on page 80, this basically goes into information that we provided specifically to Scott Meredith. He asked for some additional information. We responded with a 4-page document, basically showing and outlining everything that was provided during the open book letter, regurgitating and showing this is where these numbers are coming from. Here's our appraisal. What can we do to help you get over this hurdle of if we have obsolescence or not? Our job is to kind of go through and basically educate everybody on this system. I mean, this is a complex issue, and we understand that. It's also a very large discrepancy between the LTC RCNLD and what we're looking for from the use map appraisal provided by Patricia Cartwright. As you can see, we had some email correspondence, and then it came back that this has already been litigated, everything we need to go through Brian, Mr. Eddington, sorry, sir. And that was on August 30th. So we have had correspondence with their assessors. When in 2022, we went out to Jackson. And we met with some of the assessors. A lot of them we call, a lot of them we email, and just to make sure this is what we're doing. This is the process.
And at that time, did you provide the USPAP appraisal to the assessors?
Yes, ma'am.
So the question has been asked of a couple other folks. Was the underlying financial information and company forecast provided to the assessors?
They were provided embedded in the appraisal from Arthur Financial Services.
All right, Commissioners, we had attached a copy of the financial statements in our exhibit book. It was as Exhibit 6 for 2020. And Mr. Eddington, you may recall, filed a motion in limine, which you granted and excluded that exhibit from the exhibit book. I'm now going to proffer that same information. And Mr. Hoffman's associate, I believe, is going to explain what we're doing.
Cameron. Commissioners, I've discussed with Chairman Roussel how this is going to go. Essentially, this is not trying to re-raise the issue of the admissibility of this at this hearing. It's just saying, hey, I'd like to put it into the record and reserve it for appeal. So again, she's not asking you to reconsider the evidence at hand here, but feel free to make a motion on it.
So at this time, we will proffer this exhibit.
And again, Commissioners, obviously I have the same objection to admissibility that was raised before, and that is preserved on the proffer.
All right, so let's keep going through the open book correspondence.
One of the documents that I think we need to look at is 83. This basically shows the 36 and the 42-inch of how it was valued, how it was derived, and kind of shows we did supply this information, whatever they needed. We're happy to bring it down and show them line by line if we need to. The issue is this system, and we valued this as a system. That's how Patricia did it as well, and choosing just basically the LTC schedules. We did, I believe in 22, we did just we had a phone call with Mr. Elrod at Franklin Parish and kind of walk him through the same scenarios. Scott was the email, and then Glenn, we did meet with him in 2022. If I'm incorrect, if nothing else, we made a call to Mr. Garland. Then our next step was basically to file to the police jury.
In any of that correspondence, did the assessors express any confusion as to the basis for your requesting obsolescence?
There was some information from, again, Scott Meredith with Caldwell, and we did replied accordingly. He basically said on August 19th via email, "I've reviewed the information provided previously and it does not appear to be materially different." We replied in kind, and then we get back the same thing, saying basically, here it is. Oops. What am I looking? Yeah, and basically he came back and just said, you're representing Regency, Brian Eddington is representing us. It's already been litigated, further discussions need to go through Brian.
So when an assessor requested additional information, you provided it. Had any of the other assessors requested information, would you have provided it to them as well?
Absolutely. We've always offered to come out and meet with them, send them information, whatever they would like to review, we have it, we would be happy to do it.
And did there seem to be any confusion on the assessor's part with how you got to the percentage obsolescence? Working from the business enterprise valuation appraisal number and then the total RCNL.
RCNLD. We received no correspondence from them of how we calculated their specific parish.
So and again, they had no questions with respect to the appraisal itself or the capacity utilization report that was prepared by the engineer?
That is correct.
All right, so I think you were about to describe your appeal to the Board of Review.
Yes, in the border review is basically the same information. We try not to delineate. We try to keep everything as one big bundle project. Nothing changed from the assessor, so we provided the same information we provided to the assessor as well as to the border review.
And just to be clear, the value that you appealed, how did the assessors calculate those values?
The value was calculated based on the LTC schedule, less normal depreciation provided by the LTC.
And those schedules are based on diameter and mile?
Diameter and mile, and in the case of the Cane Hill compressor, it's treated a little separately because they do hire Pritchard and Abbott to do that valuation for the Cane Hill specifically. That one's broken out by compressor and then by ancillary equipment and everything else that's attached there.
And did do you have the numbers for the values that you requested from the Board of Review?
That's the LTC schedule.
I'm gonna ask for a 5-minute break. If you don't mind. I'm sorry to cut you.
No,
off.
this is
Okay.
this is actually a good
Stop a
spot.
little early. Let's take a 5-minute.
This is a good
break and
spot.
then come back.